Hello, everyone, and welcome back to Road to Financial Freedom. Today, we're diving into a crucial tool for investors, the stop-loss order. Have you ever experienced the sinking feeling of watching your investments lose value, wondering if you should sell or hold on? Or have you ever missed out on protecting your gains because you didn't have a plan in place? Understanding and using stop-loss orders can help you protect your investments and make smarter trading decisions. Before we get started, make sure to hit that subscribe button and ring the bell so you never miss out on our latest videos. If you're new here, welcome. Our channel is dedicated to helping you achieve financial freedom through insightful tips and strategies. Stick around until the end of this video because we're going to explain what a stop-loss order is, how it works, and why it's essential for protecting your investments. Let's start with the basics. What exactly is a stop-loss order? A stop-loss order is an order placed with a broker to buy or sell a stock once it reaches a certain price. The primary purpose of a stop-loss order is to limit an investor's loss on a security position. For example, if you own a stock that is currently trading at $50, you might set a stop-loss order at $45. If the stock price falls to $45, the stop-loss order is triggered and your stock is sold automatically. This helps protect you from further losses if the stock continues to decline. Stop-loss orders can also be used to protect profits. For instance, if the stock price rises to $60, you might move your stop-loss order up to $55. This way, if the stock price drops, you can lock in some of your gains while limiting potential losses. There are several types of stop-loss orders, each with its own advantages and disadvantages. Let's explore the most common ones. Standard stop-loss order. This is the most basic type of stop-loss order. It becomes a market order to sell the security once it reaches the specified stop price. The main drawback is that the sale price might be lower than the stop price due to market fluctuations. Trailing stop-loss order. A trailing stop-loss order sets the stop price at a fixed percentage or dollar amount below the market price. As the stock price rises, the stop price rises accordingly. This allows investors to lock in profits while protecting against significant losses. For example, if you set a trailing stop of 10% on a stock trading at $50, the stop price would be $45. If the stock price rises to $60, the stop price would move up to $54. Stop limit order. A stop limit order combines the features of a stop-loss order and a limit order. When the stop price is reached, the order becomes a limit order to sell at the specified limit price or better. This type of order provides more control over the sale price, but might not execute if the market price falls below the limit price. Stop market order. Similar to a standard stop-loss order, a stop market order becomes a market order once the stop price is reached. However, it ensures that the order is executed at the next available price, which might be lower than the stop price. Stop-loss orders offer several benefits that make them essential for both novice and experienced investors. Here's why you should consider using them. Risk management. One of the primary reasons to use a stop-loss order is to manage risk. By setting a predetermined exit point, you can limit your losses and protect your capital. This is especially important in volatile markets where prices can change rapidly. Emotional discipline. Investing can be emotional, and it's easy to make impulsive decisions when prices are fluctuating. Stop-loss orders help remove emotion from the equation by enforcing a disciplined approach to selling. Protection of gains. Stop-loss orders aren't just for limiting losses. They can also be used to protect gains. By adjusting your stop price as the stock price rises, you can lock in profits and avoid significant downturns. Convenience. Once a stop-loss order is set, you don't need to constantly monitor the market. This can be particularly beneficial for those who don't have the time to watch their investments closely. Automation. Stop-loss orders automate the selling process, ensuring that your predetermined strategy is executed even if you're not actively managing your portfolio. Not using a stop-loss order can have significant consequences. Let's explore some of the risks involved. Uncontrolled losses. Without a stop-loss order, you're exposed to unlimited potential losses. If the market moves against you, your investment can quickly decline in value, eroding your capital. Missed opportunities. Failing to protect your gains can result in missed opportunities to reinvest or diversify your portfolio. Holding on to a declining stock can tie up your capital, preventing you from taking advantage of other investment opportunities. Emotional stress. Watching the value of your investments fluctuate can be stressful. Without a stop-loss order, you might be more likely to make impulsive decisions based on fear or greed, which can lead to poor outcomes. Inconsistent strategy. A lack of stop-loss orders can result in an inconsistent investment strategy. Setting clear exit points ensures that you stick to your plan and avoid making decisions based on short-term market movements. Setting a stop-loss order involves careful consideration of your investment goals, risk tolerance, and market conditions. Here are some tips to help you set effective stop-loss orders. Determine your risk tolerance. Assess how much risk you're willing to take on each investment. This will help you decide the appropriate stop price. For example, if you're comfortable with a 10% loss, set your stop price 10% below the purchase price. Use technical analysis. Technical analysis can help identify key support and resistance levels, which can be useful for setting stop prices. For example, setting a stop price just below a support level can help protect against significant downturns. Adjust your stop prices. As the stock price moves, adjust your stop prices accordingly. For trailing stop-loss orders, this happens automatically. For standard stop-loss orders, consider manually adjusting the stop price to lock in gains as the stock price rises. Diversify your portfolio. Diversification can help spread risk across different investments, reducing the impact of any single loss. Use stop-loss orders in conjunction with a diversified portfolio to manage risk effectively. Review and adjust regularly. Market conditions and your investment goals can change over time. Regularly review and adjust your stop-loss orders to ensure they align with your current strategy. Let's look at some real-life examples to understand the practical application of stop-loss orders. Protecting against market downturns. Imagine you purchased a stock at $100 and it rises to $150. To protect your gains, you set a stop-loss order at $140. If the stock price falls to $140, the order is triggered and you sell the stock, locking in a $40 gain, limiting losses in volatile markets. Suppose you bought a stock at $50 and it's currently trading at $45. To prevent further losses, you set a stop-loss order at $42. If the stock price drops to $42, the order is triggered and you sell the stock, limiting your loss to $8. Trailing stop-loss for profit protection. You invest in a stock at $30 and it rises to $50. You set a trailing stop-loss order with a 10% trail. As the stock price rises, the stop price adjusts accordingly. If the stock price reaches $55, the stop price moves up to $49.50. If the stock then falls to $49.50, the order is triggered and you sell, locking in a significant profit. In conclusion, a stop-loss order is a powerful tool for protecting your investments and managing risk. By understanding how stop-loss orders work and implementing them in your investment strategy, you can limit losses, protect gains, and make more disciplined trading decisions. If you found this video helpful, make sure to give it a thumbs up and subscribe to Road to Financial Freedom. We've got plenty more content designed to help you navigate the complex world of finance and investing. Be sure to check out our other videos for more tips and strategies on making smart money choices. Thanks for watching, and we'll see you in the next video.